Ask Abby, providing answers, insights, and education designed to give you the tools and knowledge you need to thrive financially and live confidently in retirement.
And welcome into Ask Abby, your opportunity to get answers from an experienced, qualified financial professional. Abby Reed, our resource for a common sense approach to planning for your financial investment and retirement future. You can visit online and submit your questions at goaskabby.com. Abby, always a pleasure to have you on the program.
It's great to be here, Peter. Thanks for having me.
It is wonderful to have you back. Now, under circumstances, though, Abby, because we are experiencing some market volatility, nobody likes to see downward moving markets or account balances. Losing money is not our favorite. So what do we need to know and understand? And perhaps what do we need to do about the market volatility that we're experiencing here in 2022?
Such a great question, and one that we're getting on a daily basis from people that are planning for retirement or at retirement or even in retirement. So anybody that is kind of in that range. A lot of times we have a pretty short frame of reference. And so while this kind of market movement and this volatility is fairly normal and actually happens more often than we might think, the past, if you put this year aside, the past 5, even 10 years has had pretty little volatility. And it's been pretty much a straight elevator up. And so people are very uncomfortable with this level of volatility, especially what we saw in 2020 and now again in 2022. And what we're seeing is the longer it goes on, the more and more uncomfortable people get. So in 2020, that was even a larger drawdown in a lot of circumstances, but it popped right back up really quickly. So when it continues for a more extended period of time, that's when people really start to get nervous and want to know, when is this going to end? Do I need to get out of the market now? How do I protect myself? And that's a hard question to answer for a lot of people, because if there's a conservative investor and then there's an aggressive investor, those are going to be a little bit different answers. So we use some technology where we actually can quantify our clients' risk tolerance and then compare that to their current portfolio and see if there's an alignment there. And that's one of the best places to start, is to see, are your investments, is your portfolio currently appropriate for your goals, for your risk tolerance, and for where you are in life?
Yeah, it might be equal to saying I'm comfortable swimming in a swimming pool, but my portfolio is acting as though I'm comfortable deep sea scuba diving, swimming with the sharks. A lot of people are very out of alignment when it comes to risk tolerance versus their actual risk exposure. And that may lead to the discomfort during down markets like this.
Right, exactly. So for me personally, I love the pool. I even like the lake, depending on the lake. Not comfortable in the ocean. I've been deep sea fishing a couple of times. I hated it. So that's something that I don't want to do. I don't want to get into. And it's the exact same with investing and with the hundreds of thousands of options that are out there. They're not all going to be appropriate for everybody. So it's really important to make sure that the investments you have, the plan that you have, reflects your goals, your risk tolerance, and where you are in this stage of life, and that it's changing with you. So as we go from the accumulation phase to the preservation and distribution phase of money, which is getting ready for and being in retirement, things really need to change. And a lot of times the rules are very different in that phase of life. And unfortunately, there's not much education around that. It's really more education and media exposure to the accumulation phase. But there does need to be that match there. And most of the time when we meet new people and new couples, there's a misalignment there. And they have a sense that, maybe I'm taking on a little bit more risk than I really want to be, but they don't have a way to really quantify it or what to do about it. And so we're able to help with that with our process that we use.
The direction of our money may matter as much, if not more, than the direction of the market for how we should be positioned and how we should feel about taking risk with our money.
Right. So what people experience as they get closer and closer to retirement is most of the time, it's not a all of the time thing, but most of the time their risk tolerance is going to go down and down and down, or they get more risk averse as they get closer to that finish line. Most of the time at that stage in life, you've really done most of the hard part. So you've sacrificed, you've saved, you invested, and you've accumulated more money than you've probably ever had in your life.
And now we just don't want to lose it all.
Right. So even a 5% or a 10% loss that you may have experienced, when you were 20 or 30 that didn't bother you, that's a lot more money on the line now. And so the strategies really need to change, because if they don't and you experience a loss that's outside your risk tolerance, that's when people can make some emotional decisions and maybe get all the way out of the market. And that can really affect long-term results and have a negative impact on the probability of success in retirement.
Now, Abby, you mentioned that downturns in the market actually happen much more frequently than most investors realize. And in fact, some information you shared with me before the program, over the last 100 years, 16 different bear markets, a bear market technically quantified as a 20% loss or more. And on average, those downturns have actually been more around 39% down in the market. So we've seen losses this year, but maybe not as significant as many of these previous downturns and bear markets. What do we need to know about what is driving this current downturn and where we may go from here?
So one of the most important things that we like to point out and educate people on during this downturn that's really causing it and has kind of been the catalyst for this is the change in Fed policy caused by the pandemic. So we've seen really a complete reversal in a lot of key areas. During the pandemic, the federal government pumped in money to the economy, so via stimulus checks, unemployment, those type things, and they reduced rates, which also pumps money into the economy. That was to basically help us from collapsing into a recession or a depression as far as the economy goes. And now they're trying to reverse that policy because of inflation. There was too much liquidity in the economy, and that led to really, really hot inflation numbers. Prices are through the roof in a lot of different areas. All of us are feeling that. And so what the Fed has been doing this year is raising rates pretty consistently. And they just came out and said that they're going to continue to do that until they can get a handle on inflation and until the economy is back where they really want it to be. So what that's done is bond funds and bonds, existing bonds, and interest rates have a inverse relationship. So in 2020, when the rates went down, bonds actually did pretty well. They went up in value. However, as the interest rates are continue to get raised, bond funds and bonds, individual bonds are going to lose value unless they're actively managed. If you are just holding a bond fund, that's going to lose value. In the long term, it might be a good thing for bonds, but what we've seen is something called systemic risk, where bonds and stocks have both fallen. So the traditional 60-40 portfolio, 60% stocks, 40% bonds, that's had one of the worst starts to a year in a really, really long time. And that's going to affect more conservative investors, just like it's affecting aggressive investors. So that's something to keep in mind as well, is there's really not been too many places to hide as far as the market goes, where everything has been going down pretty consistently since the beginning of the year.
Yeah, and fantastic, because that was going to be one of my next questions. Based on my risk tolerance and what kind of investor I am, conservative, moderate, aggressive. Should my expectations in declining markets be different, or am I still at risk of losing money?
So, depending on where your income is coming from, I think that that's one of the most important things to talk about first when we're talking about risk and retirement. So, if you have a higher percentage of your income coming from guaranteed sources, protected sources, so they're not going to have to fluctuate based on a market downturn or bonds going down, stocks going down,
My
or whatever.
paycheck
Right,
or pensions
exactly.
or Social Security if I were to be retired.
Exactly. Yep. So sources of income that are not correlated to the market, that's going to take that pressure off of the portfolio. And what I see on really a day-to-day basis is the clients that I have that have a higher percentage of their income and retirement protected, they don't like losing money. Nobody does, but it's not they don't have the anxiety, they don't have the fear that maybe somebody else does that's really relying on that market portfolio to generate the income that they need. It's been a rough year for people that are using the 4% rule that's now the 3% rule. So that's something to keep in mind as well as if you're hopefully if you are generating that income from protected sources, market volatility is a little bit less dangerous for you, but you still need to be invested within your risk tolerance, and make sure that you're not having fluctuations that you are very uncomfortable with and that make you want to make a change at potentially the wrong moment. So a lot of times what we see happen is if the market goes down so much that somebody's uncomfortable with that drawdown, that's when they want to get out of the market. And so they sell low, and then eventually the market comes back. Who knows how long it's going to take, but it does come back eventually. And then they see everybody making money and everybody's doing really well. The market's doing great. That's when they get back in. And so they're selling low and they're buying high. And that really affects long-term results, and that has to be avoided as well.
But we've been told that we have to take risk in order to make progress and achieve growth. And we've also been told that stopping losses is equivalent to locking in losses. Is it possible, Abby, to make forward financial progress while eliminating losses or minimizing the possibility and still make forward gains?
Yeah, so that's the question, is how do I still thoughtfully participate in the market instead of hiding all of my money in the mattress or burying it in a coffee tin out back, without putting my entire retirement at risk. So how do you make those decisions? What's the right mix of different investments for you? How do you thoughtfully do that? And what we really focus on is thoughtful, smart portfolio construction. And what we like to do is have a combination of more conservative part of the portfolio that is principal protected, that can have a percentage of the gains, if the market goes up, or even some type of a fixed rate of some kind. That's the part of the portfolio that we like to generate income from if there's additional income needed to keep up with expenses. And then the other side of the money management system that we use is the growth side. So what we want to do there is have exposure to a certain amount of growth or risk, but have it diversified in as many ways as possible. So that means diversification as far as asset class goes. Something that we've seen a lot of recently is an over allocation to US stocks and bonds because they have outperformed recently as far as comparing it to international and global. But a lot of the studies that have been done by some of the big guys, JP Morgan, those type companies, and our opinion as well is that trend might change. So it's really smart to have a diversification as far as asset classes, where those asset classes are located. So US and global. And then also with the fixed income part of the growth portfolio, there are alternatives out there that can provide some principal protection with a much higher upside than a CD or a money market or any of those lazy money type accounts. That can be a bond alternative until bonds start to, hopefully at some point turn around and play a little bit better role in the overall investment, and then also making sure that if we're using bond funds, that they can be actively managed by our investment committee, by us, so that we're reducing interest rate risk as much as possible with that portion.
Talking with Abby Reed of the Reed Financial Group and discussing what is of concern with most savers and investors right now: stock market volatility and investment losses. Abby, if we are worried about stock market losses, sum it up for us, recap. What are maybe the top things that we need to know, understand, and perhaps act on right now?
If you are 5, even 10 years away from retirement, it is a perfect time to sit down with us. We offer a complimentary strategy session, discovery session, where we can go through basically your financial picture, talk about what's on your mind, and also let you know what we see. If we were in your position, we'll tell you, this is what I would be concerned about right now if I was in your stage of life and I was in your shoes. And this is how we might be able to assist you take care of those risks and put yourself in an even better position in the future. Position yourself a little bit better way. Also, it's a great time to look at your allocation. Most of the time when we first start meeting with people and looking at their portfolio, they are taking on a lot more risk than they really realize. And a lot of times more risk than they need to. They don't need to take that much risk. They've already done the hard work. They've already accumulated all of it. It's not time to try and hit a grand slam. We're looking for base hits to keep up with the lifestyle they want to live in retirement and get us the rest of the way. So we can ratchet down on that risk. It's really unnecessary at that point in time. And also knowing that this is what the market does. So if we're not prepared for things like this to happen, and if our portfolio isn't built to combat some of this volatility, then we're going to be in trouble not only this year, but many times down the road, because this is not the last time this is going to happen. It's not the first, and it's not going to be the last.
We appreciate the insight. And if you have questions or concerns, if you would like a complimentary portfolio investment and retirement review, you can visit goaskabby.com or give a call to Reed Financial Group 678-442-0255. That's 678-442-0255. We understand that there is risk associated with investing and that unfortunately most of us are uncomfortable with the volatility that we are seeing, certainly with prolonged or significant losses in our investments. There are ways to accurately gauge your risk tolerance and then make sure that your investment risk exposure are in alignment. That is through the complimentary risk analysis and strategy session there at Reed Financial Group with Abby Reed. If you would like to take advantage, again, call 678-442-0255 or visit goaskabby.com. They are here to help the retirement family at Reed Financial Group. Abby Reed, always a fantastic resource for information and perspective on the financial world and all of the difficulty planning topics. Abby, we appreciate the time. Always a pleasure to have you.
Thanks, Peter. Great topic today. It was fun to talk about.
Here to answer your financial questions, visit the website goaskabby.com for show resources and to submit your questions and get answers, or to schedule your complimentary financial investment and retirement planning strategy session. You can also reach out to Abby directly at 678-442-0255. That's 678-442-0255 or at goaskabby.com.
Investment advisory services offered through Brookstone Capital Management, LLC, BCM, a registered investment advisor. BCM and REIT Financial Group are independent of each other. Insurance products and services are not offered through BCM, but are offered and sold through individually licensed and appointed agents. Third-party ratings and recognitions are no guarantee of future investment success and do not ensure that a client or prospective client will experience a higher level of performance or results. These ratings should not be construed as an endorsement of the advisor by any client, nor are they representative of any one client's evaluation. The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature and not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.